Hey everyone, welcome back to Corporate Decoder. Today, Virgin Galactic Holdings Incorporated SPCE just filed an 8K detailing a significant debt exchange, and I am seeing a clear strategy to shore up their balance sheet. Quick note, this is not financial advice, just my take on public filings for educational purposes. Virgin Galactic is swapping a big chunk of their debt for stock, and it tells us a lot about where they stand as they push towards commercial flights. Let us dive into this filing from the 22nd of June, 2026. Virgin Galactic Holdings Incorporated, or SPCE as you know it, has made a move to clean up some of their outstanding debt. They entered into a deal to exchange about $52.5 million worth of their 2.50% convertible senior notes due in 2027 for shares of the company's stock. Why are they doing this now? The company states it is to improve their liquidity, manage their cash, and basically strengthen their financial health as they gear up for commercial operations, which are targeted for the last 3 months of 2026. This is a pretty big deal because by doing this exchange, they are cutting down their total outstanding 2027 notes by about 75%. We are talking about going from around $70.4 million in debt down to just under $18 million. That is a substantial reduction, and it frees up a lot of financial breathing room. Now, how they are calculating the number of shares to issue is pretty interesting. It is not a fixed number. Instead, they will figure out the exact number of shares over a 5-day period starting on the 22nd of June. For each day in that period, they will take 1/5 of the debt being exchanged, including any interest that has piled up. Then they will divide that amount by the average stock price for that specific day, known as the daily volume weighted average price or daily VWAP. They will add up the shares from these 5 days, and that will be the total number of shares issued to the debt holder. They are also issuing what are called pre-funded warrants. These are basically like shares, but they have a very small exercise price, practically zero. The company is doing this to help the investor manage how much of the company they own a stake in, but it is meant to be financially the same as just giving them shares. There is a crucial detail here though. The stock price used to calculate the shares will have limits. It will not go below $3.03 and it will not go above $4.09. This protects both Virgin Galactic and the investor. For the company, it means they are not issuing an explosion of shares if the stock price drops dramatically during that observation period. For the investor, it ensures they get a fair value even if the stock price surges. It is important to note that these price limits only affect how many shares are issued, not the amount of debt being forgiven. This whole transaction is being done under a specific exemption from the usual registration rules for new stock offerings. They are using Section 4 Add 2 of the Securities Act, which is generally for private transactions, not involving public offerings. This means the shares are only being offered to investors who are considered qualified institutional buyers or institutional accredited investors. Essentially, these are sophisticated investors who are already well versed in financial markets. The shares have not been registered with the Securities and Exchange Commission, or SEC, and they cannot be sold to the general public without registration or another exemption. This is a common practice for companies looking to raise capital or conduct exchanges of this nature in a more streamlined way. Looking at the broader picture, Virgin Galactic SPCE has been in a tough spot lately. Just a day after this filing, headlines showed their stock underperforming compared to competitors. This debt exchange signals a company trying to navigate financial challenges as it aims for profitability with its new space tourism venture. The fact that they are managing their debt load in this way suggests they are trying to avoid further dilution or a more drastic financial restructuring. It is reminiscent of other companies in challenging sectors that have had to make tough financial decisions to survive and focus on their core operations. Think about companies like WeWork or even some of the struggling retail chains that have had to refinance or renegotiate debt to stay afloat. This move by Virgin Galactic is about buying time and strengthening their position for what they hope will be a profitable future in space travel. However, there is a slightly positive note from around the same time. Virgin Galactic was added to the S&P Aerospace and Defense Select Industry Index. While this might sound like a big endorsement, it is often more of a technical adjustment based on market capitalization and sector classification. It means that index funds tracking this specific index will now have to buy SPCE shares, which could provide some small, steady buying pressure. It is good to see some positive news alongside the financial maneuvering, but this debt exchange is the far more significant event in terms of the company's immediate financial health and strategic direction. Another headline from the same day cryptically mentions dilution and legal cleanup. This debt for equity swap is a form of dilution, as new shares are being issued, which can reduce the ownership percentage of existing shareholders. The fact that this is happening at the same time as they prepare for commercial operations suggests a delicate balancing act. They need cash and a strong balance sheet to launch and sustain these expensive space flights, but issuing stock to pay off debt inherently dilutes current shareholders. This is a classic challenge for growth companies, especially in capital-intensive industries like aerospace. So, what is the story here? Virgin Galactic is in a critical phase. They are trying to transition from a development company to a revenue-generating one. This debt exchange is a proactive step to reduce their financial obligations, which is a sensible move to improve their balance sheet before what they hope will be a successful commercial launch. The key challenge for them will be executing their flight plan flawlessly and generating consistent revenue to offset the high cost of space travel. This move is about survival and positioning for that future. What I am actually looking for is how effectively they can scale their operations and achieve profitability without further significant dilution. Oh, and the research tools I actually use are linked in the description. They help keep this channel going, that is my take. Stay decoded for more in-depth analysis like this. Be sure to like this video, subscribe, and join our Discord community linked below.